Why do NBFCs need funds? Let's understand, as you know, a non-banking financial companies, NBFCs play a crucial role in extending credit to individuals, small businesses, and home buyers. However, unlike traditional banks, NBFCs are not permitted to accept public deposits. To sustain and expand their lending operations, they must explore alternative funding sources. Two primary methods of raising capital include: 1. Debt financing, borrowing funds with a commitment to repay, typically through non convertible debentures, NCDs, or term loan. 2. Equity financing, raising capital from investors who eventually acquire ownership, commonly through compulsorily convertible debentures, CCDs. A deeper understanding of these instruments is essential for evaluating their suitability for different business needs. Non convertible debentures, NCDs, pure debt instrument. Think of NCD as a loan taken from multiple investors instead of a bank. NBFCs issue NCDs to the public or private investors. Investors give money to the NBFC. The NBFC promises to pay interest, like a fixed deposit. At the end of the term, the NBFC returns the principal amount. Example: imagine an NBFC issues 100 crore rupees worth of NCDs at a 10% annual interest rate for 5 years. Every year, it must pay 10 crore rupees as interest. At the end of 5 years, it must return 100 crore rupees to investors. Key features of NCDs: fixed returns for investors, regular interest payments, no ownership change. Investors do not get shares in the NBFC, secured or unsecured. Some NCDs are backed by NBFC assets, while others are riskier. Compulsorily Convertible Debentures, CCDs, hybrid of debt and equity. Now, let's talk about CCDs. Investors give money to the NBFC, but instead of repaying them, the NBFC converts their investment into shares later. This means investors become part owners of the NBFC. Example: an NBFC raises 50 crore rupees through CCDs with a 3-year conversion period. The deal says that after 3 years, each CCD will convert into shares at 500 rupees per share. If an investor invests 5 lakh rupees, they will receive 1000 shares of the NBFC after 3 years. Instead of getting their money back, they become a shareholder. Key features of CCDs: starts as debt, becomes equity, no repayment needed. NBFC's debt burden reduces. Since CCDs become shares, the NBFC doesn't have to return the money. Investors get ownership. They can benefit from company growth. Key differences between NCDs and CCD. NCD is a pure debt instrument, whereas CCD is hybrid, debt plus equity. NCD repayment is principal plus interest, whereas CCD converts into shares. NCD has fixed returns interest, whereas CCD has ownership and potential profits. NCD increases debt burden. CCD reduces debt burden. NCD must repay investors. CCD has no repayment but gives up equity. NCD governed by RBI and SEBI. CCD governed by SEBI and Companies Act 2013. RBI and SEBI regulations for NBFCs. RBI rules for NCDs. NCD minimum tenure, 1 year for private placement. NCD interest rate cap. NBFCs cannot offer excessive interest rates. NCD credit rating must be rated by CRISIL, ICRA, or similar agencies. Security. Secured NCDs must be backed by assets. NCD debenture trustee required to protect investors. Listing requirement. If issued to the public, NCDs must be listed on NSE BSE. CB and Companies Act. Rules for CCDs mandatory conversion. CCDs must convert into equity within a defined time. Pricing regulation. SEBI ensures fair valuation during conversion. Voting rights. Once converted, investors get shareholder rights. No RBI restrictions. CCDs are not treated as debt, so NBFCs avoid debt regulations. Somri, which one should an NBFC CCDs if you want fixed borrowing with a clear repayment structure? You don't want to dilute ownership. You can afford regular interest payments. Choose CCDs if you want long term funding without repayment pressure. You are okay with giving investors equity in the company. You want to reduce your debt burden over time. Final thought: both NCDs and CCDs are great tools for fundraising. The choice depends on whether the NBFC wants to raise debt or equity capital.